episode every month, only on Bloomberg. The island emerging as a flashpoint between the U.S. and China. Taiwan's presidential election is drawing global attention.
Taiwan is an elephant in the room.
After the Biden-Xi Jinping summit,
we had some pretty tough talk.
Bracing for potential war scenario.
As voters head to the polls in January, Bloomberg takes a close look at the candidates, the issues at stake, and what it means for the world. In case you missed it, watch Taiwan Decides, a special report, tonight at 9:30 Eastern. Bloomberg, context changes everything. Why do the biggest names in business choose Bloomberg?
That is a great question.
It's a great question.
Great question.
Great question.
That's a question I get all night.
Bloomberg, top experts, great questions.
Live from New York City for our audience worldwide, Bloomberg's The Fed Decides starts right now.
This is a special edition of Bloomberg Surveillance with Tom Keene, Jonathan Farrell, and Lisa Abramowitz. Bloomberg Surveillance, The Fed Decides.
From New York City on TV and radio, the Fed decision about 28 minutes away. The last Fed decision of 2023. The pivot for this market is in sight. TK, we're pricing in a ton of rate cuts in this market for 2024. Will we get any kind of endorsement from this Fed chair in the next 60 minutes?
Enraging debate around what we're going to go through in the next couple hours over where are we a year from now, with the clarity that we have of looking back when we were 1 year ago, thinking this December meeting would be like this. We nailed that. Same uncertainty today, massive uncertainty about the path.
Hey, TK, never mind 12 months. Where are we 2 hours from now? Where are we 2 hours from now?
Yeah.
Three-part story. We'll get a statement, we'll get projections, and Lisa, then we get the news conference. And a lot of people have got the same question. We've had a move of 10% on the S&P 500. We've had a monster rally in the bond market. Do we get some pushback from Chairman Powell a little bit later?
We were hearing from Andrew Hollenhorst that he has to be kind of awkward here. He has to push back to some degree. And yet he has a sense that disinflation does open the door to rate cuts. So here's the question. And you really raised this earlier. How does he address the fact that Chris Waller was talking up the potential of rate cuts, and then pair that with a statement of economic projections and their own rate cut projections and when they'll start next year?
And never mind Governor Waller, that's easy. He's on the committee. Let's talk about Tom, Chair Yellen, Vice Chair Biden in the last couple of days, weighing in on what the Fed maybe and maybe shouldn't do.
This is a joke at 7 a.m. It's not a joke here at 1:33, 20 minutes away. John, you're right. And the key thing there, historically, the key thing there is Vice Chairman Biden and to see what he does. But the answer is there is some political pressure, some overview. And I'd also point out there's international pressure. All the people we talked to today says a massive devaluation in Argentina, off the radar, Sri Lanka off the radar. My answer is global slowdown is on the radar.
We joked about President Biden. Here's the quote. We're in a sweet spot following that jobs number. This is the line from Friday, Lisa. A sweet spot that's needed for stable growth and lower inflation, not encouraging the Fed to raise interest rates.
That's what we heard from Chair Yellen, as you call her secretary, Treasury Secretary. And she spoke earlier today, and she was talking about how she is going to let the Fed do their thing and that she has confidence they're going to do things well, but that you could cut rates just as a de facto step should inflation come down, because if you didn't, there would be a de facto tightening in financial conditions, even with the disinflation. So she's going to the Chris Waller school of thought at a time when there is the pace of inflation coming in, but prices are still rising. And this is what is such a difficult and awkward thing to talk about.
That's the tricky dance for many of these policymakers. Let's start with the scores this afternoon on the S&P 500, coming off the back of a 3-day winning streak on the S&P. Equities right now just about unchanged Exchange struggling to make it day 4, and the bond market yields are lower by 3 or 4 basis points here, Bramo, 416.23.
This is the state of play coming up in the lead up to the Fed rate decision. JP Morgan's Priya Misra and Deutsche Bank's Matt Lazzetti will be joining us at 2 p.m. We do get what that rate decision is. They will be on hold, but the key will be the statement of economic projections, and any language changes will get immediate reaction from KPMG's Diane Swank, PGIM's Greg Peters, Bank of America's Michael Gapin, and SocGen's Subhadra Rajappa. We'll get the press conference breaking it all down. Chair Powell's every word will be former New York Fed President Bill Dudley and BlackRock's Jeff Rosenberg as we try to understand how the market's going to take what he says.
It's going to be interesting to see. Let's get right to it now. We begin strong with Priya Misra, fixed income portfolio manager, JP Morgan Asset Management. You know, Priya, I got 8 ways to go here, but what I got is 8 different outcomes of this meeting today. You have a shocking outcome of substantially lower interest rates, of a 10-year yield driving down well into the lower 3% range. Is that Fed-induced or growth slowdown-induced?
I think it's a combination of both. Interest rates move based on fundamentals of the economy and the Fed response function. And that reaction function is what you're going to get from the Fed today. I mean, I think, the market's going to look through the economic projections because the Fed, like all of us, looks at the data and has to revise as the data comes in. But if the Fed reaction function today suggests that they see that as inflation comes down, they need to cut rates, and I do think they're going to suggest that. I think the debate is it 50 basis points of cuts or 75? In a soft landing scenario, if they're cutting 75 or 50 basis points, how much do they cut in a hard landing? Are we talking 200, 300 basis points? I mean, my view is that with real rates this high, the lags are kicking in and the economy is slowing down. Global growth is anyway slowing down. So in the hard landing camp, I do think long-end rates have a lot of room to decline. Even in the soft landing case, the Fed's cutting rates. The Fed catch-up, hiking 75 basis points, getting rates up to 5, getting real rates high into restrictive territory, tightening financial conditions, that's behind us. The market's forward-looking, and now it's all about when do the cuts start and how much in totality are they going to cut.
Priya, as Lisa suggested, this is a really delicate dance. How does the chairman signal in the news conference the work's not done when the dot plot might imply 2 or 3 rate cuts in 2024?
Sure. So I think 2 o'clock is going to be really tricky because they have the statements and the dot plot. And I think it's going to be hard for them to sound hawkish at 2. At 2:30, I think Chair Powell will have his chance. I think he should take a bit of a victory lap. Remember inflation was transitory. Well, it's looking like it's coming down. And so he can actually address and acknowledge that it's coming down, but stop short of saying mission accomplished. And then talk about rate cuts in a normalization sense, as opposed to let the market run away with rates are going back to 0. Start the talk of maybe you have to recalibrate policy and get rates, normalize rates as inflation comes down to keep real rates constant. I think that's how he's going to try. It's a very delicate balancing act. I think that's where the press conference is going to be important. So I would look at the 2 o'clock reaction, and then the 2:30 reaction might be a little different because I think he might try and say not so fast. We're not ready to start cutting all the way down. It requires a lot of things to go right. So I think he's going to try and finesse it, but it's a challenge for the Fed today.
Priya, we've been hearing from some of the Fed speakers. They're concerned about anecdotal evidence showing a faster slowdown than what we currently see. Do you expect that to be reflected at all in the statement of economic projections, where growth's been upgraded and unemployment expectations have been downgraded?
I think it's hard for the Fed to show that, especially when you're looking at average numbers like the unemployment rate, which is going up because participation's going up, for example. So I think it might be harder, but I am curious to see how much they move the unemployment rate, next year. If they do have, if you look at the underlying labor market data, I know Friday was a strong payroll report, but you look at the underlying, you strip out the strikers or the government jobs, it's really coming from 2 sectors. There is slowdown in the labor market. But I think it's hard for the Fed to finesse that. I think all they want to say is we'll be mindful, we'll watch data and respond accordingly. But I don't know where you can see that very clearly in the statement of economic projections beyond just the unemployment rate. Perhaps a 4.2 or 4.3 is where they can get it up to. I think anything higher would be an odd move by the Fed because we don't really see it clearly in the aggregate data. the cracks are developing, and I think Chair Powell can hint at it at the press conference rather than show up clearly in the forecast.
Where's the asymmetry in market positioning right now heading into this meeting? In other words, where's the biggest response potentially going to come from with a surprise, either with a more hawkish or dovish type of tone?
So I actually think a more dovish tone will have a bigger reaction. I think a lot of people missed buying the 10-year at 5%. And then they've been waiting. We've been waiting. You know, when you get back up, we'd like to come in and buy. There's a sense of a FOMO move, you know, just buy everything rally going into year end. So I think if the Fed suggests that in soft landing, they can cut 3 times, 75 basis points or 100 basis points next year, the market's pricing in 100, well, you should price in some probability of a hard landing. So I think you'll get a much more reaction to lower rates in a dovish Fed commentary, either nervousness about growth or this idea that they can cut a lot more rates. If you get a hawkish Fed, I think the market almost is going to disbelieve the Fed, because the Fed can change its mind. It's done that before. Yep. It's responsive to data. So I think that's where the asymmetry is.
It's so true. Priya, stick with us, stay close. Priya Misra there of JP Morgan, with less than 20 minutes to go until that Fed decision. What Priya said there, Lisa, is so important. Sequencing matters here. So at the top of the hour, in about 20 minutes' time, you'll get the statement and the projections. 30 minutes later, you get the news conference. And I would say it's kind of like getting earnings. You get the earnings, and then you get the earnings call. Do you really want to make a move on the earnings before you've heard the call? And we have a real potential here to be whipsawed by Chairman Powell 30 minutes after the decision drops.
She was saying basically that's the base case right now, that we're going to get whipsawed because it's going to sound dovish, and then he's going to come out, Jay Powell, and have to be hawkish. That is the expectation, and then it'll be a wash.
You know, I'm going to go all Italy good on you over at BMO Capital Markets. The most interesting number here into this Fed meeting and through the conversation, the press conference, is a 10-year yield. We have come so far so fast, John. I got a 4.54 upper range on the 10-year, and where it gets interesting is 4.06%. So if we come in 10 basis points lower yield, that's demonstrative in this at this moment today.
What's interesting, TK, as well, is where the 10-year was the last time they met.
Yeah, it's technically elegant.
70 basis points higher. The conversation continues. Deutsche Bank's Matt Lazzetti with JP Morgan's Priya Misra. Your equity market on the S&P 500 is totally unchanged. The Fed decides. The decision just around the corner.
That's me, Max. What's up? How are you? I have been writing about Wall Street for almost 15 years. And what that means is I write about feuds and rage and rises and falls and comebacks. And every now and then, I also write about a couple of villains. Thank you so much. And now, I am about to do something new and very, very scary. We are making a show, and it's based on Bloomberg Businessweek magazine. So what is this show about? It's a show about money, power, culture, pop business. We're gonna ask complicated and profound people about their ideas, their careers, their lives, their risks, their failures, their imagination.
It's so incredibly liberating not to care what other people think.
I was giving my tools to other communities. I wanted to bring those tools home.
Tune in. Please, really actually tune in. I desperately need an audience.
I think that it's hard to put your head around any narrative. Let's just be honest. We've had sort of a shift in, are we in some sort of stagflation fears moment? People were talking about that all day yesterday.
It's a Fed pivot party, and we're all invited.
There will be a eventual pivot, towards easing.
Traders right now are pushing this dream of 4 rate cuts next year.
Markets have been celebrating this idea that there's disinflation in the pipeline.
And inflation's come down faster than many thought.
Things are at least directionally on track for the soft landing.
The market has been overly optimistic on when the Fed has cutting.
Is running too far ahead of Jay Powell and team.
They will definitely fight back.
Push back hard on cuts next year.
On where the market is, where it's gotten a little bit ahead of itself.
We still need to respect the fact that the last mile of the inflation journey is often the most difficult.
They have to keep some vestige of this tightening bias.
I don't think that that's a message that's going to be believed by markets.
And the market is like, we don't believe you.
It's up to Powell how much he's going to push against that market pricing.
Live from New York City this afternoon. Good afternoon. Good afternoon. Alongside Tom Keene and Lisa Ravitz, I'm Jonathan Ferro. That Fed decision 15 minutes away. The scores look like this on the S&P 500, totally unchanged on the session. But since the last time this Fed met, we've rallied hard by about 10% on the S&P and more on the NASDAQ. Check out the bond market. Switch up the board. 2-year, 10-year. Think about where the 2-year was the last time the Fed met. 5.08% that morning before that Fed decision. The 10-year that morning, TK, 492 is where we opened on the 10-year that morning. And here is where we are right now. 466.96 on a 2-year, down 6 basis points today. On a 10-year, 416, down 4 basis points this afternoon.
I'm watching the 10-year just by chance today. I think it's technically very eloquent and really derives to a lower. I just want to say with the work that our team does to put together, the only reason I do this show is all those different voices at the beginning of the B block of the Fed decides.
It's the only reason you're here?
It's the only reason I'm here. I mean, it's hilarious. All the different opinions, the language, the opine. How many of his questions today is he going to read off a piece of paper? Almost precise.
Well, he should know what's coming based on that.
Yes.
That captures the consensus almost perfectly. This is about pushback. How much pushback we get in this news conference a little bit later, if any, at all. I want to finish on foreign exchange, Lisa. Important. The tug of war that's set to take place. We're talking about the Fed in isolation. You need to talk about the Federal Reserve versus the ECB versus the BOE, and think about the FX market, the dollar index, stable, just about unchanged. The euro going nowhere, Lisa, 107.86. The other side of the trade. It gets interesting in the next 48 hours.
All I can say is why would, to your point, anyone trade right now on this trade, this currency pair ahead of the Fed meeting and then the ECB meeting tomorrow at a time when they're largely expected to cut rates first?
12 minutes away. We've got to get to Matt Lazzetti. He's got to get to his Deutsche Bank clients and representatives across all of the Deutsche Bank world. He's their chief U.S. economist. Priam is with us as well. Matt Lazzetti, I really got to go to the real economy because of your claimed, there'll be a slowdown, but it's out there somewhere. You nailed that this year. Let us reframe the importance of slowing economic growth to Chairman Powell here in 10 minutes. How does slowing American GDP filter into today's event?
Yeah, I think the bigger story for Powell and the Fed has been how quickly inflation is coming down, and certainly whether or not they can cut rates purely on an inflation story. And that's what Governor Waller was getting at 2 weeks ago within his comments, is what's driven the market dynamics over the past 2 weeks to price these substantial rate cuts. So I think from the Fed, from Powell, we'll continue to hear that they do want to see some slowing in the economy. They do want to see a labor market that continues to come into better balance. But I think first and foremost, the most important development has been inflation coming down faster than anticipated from the Fed's perspective, and the scope that gives them to cut rates next year.
Does the job economy exist in today's analysis?
Yeah, no, I think the labor market is, the fact that has come into better balance very quickly over the past 6 months or so is really important in that assessment. But I think given where we are on the unemployment rate, the quits rate, job openings coming down, the labor market is not an additional reason for the Fed to sound hawkish at the moment. I think that they can kind of transition away from the labor market and the concern around that it's too tight and driving inflation, and then pivot towards focusing on the inflation data, which just undeniably is showing a lot of progress over the past 6 months.
The Fed has two mandates, right? One of them is to bring down inflation, and then there's also this question of making sure they avoid some sort of hard landing going too far. Where is that balance of risks right now, given the fact we have seen disinflation, but there's still a lot of questions about how sticky that is?
Yeah, no doubt. Over the past 18 months, the Fed has leaned heavily towards doing too much potentially in terms of tightening, because the risks were that inflation becomes sticky, becomes embedded, and it's more difficult for them to get down over time. I think what we've seen, particularly over the past 3 or 6 months, is a pivot towards and a transition towards concerns on the growth and labor market front, and that'll continue. It's quite natural that that continues as inflation comes down. You become a little bit more worried about the growth side of the dual mandate, the labor market side of the dual mandate. And I think we'll continue to hear that from Chair Powell today, that they are concerned about upside inflation risks, but that balance of risks from their perspective is coming into better balance.
That said, we've been talking a lot about the easing in financial conditions over the past month and how this goes exactly counter to some of the goals. How much do you think that Jay Powell needs to push back on that to keep the gains that they've made with respect to bringing inflation down?
I think for the Fed, financial conditions are completely context dependent. So if they were not achieving progress on inflation, if the labor market was still extraordinarily tight, if we were still seeing growth that was well above the potential growth rate, that the Fed would want to lean back on that and kind of push back on the financial conditions tightening that we've seen. But in the context of seeing a lot of progress on inflation, being a little bit concerned about downside risks to growth in the labor market, I think the Fed is a lot less prone to push back on that. I think what you'll hear from Chair Powell is what we've heard from his colleagues is that financial conditions, even though they've eased a lot over the past 6 weeks, do remain tighter than they were earlier this year. And I think just the underlying reality is they don't need them to be as tight as long as they're getting progress on the inflation front.
Let's break some rules. Let's put some numbers on it and some dates as well. Matt Lizzetti, when do you think they start cutting, and by how much?
So we have had for a long time an expectation that they start cutting rates in June and that they cut rates by 175 basis points next year. Certainly that was, I think, a lot more aggressive than the market was pricing, certainly 6 weeks ago, 3 or 4 weeks ago. The market has come far more in line with that expectation. I think critically for today, Chair Powell will probably somewhat push back on the market pricing, perhaps say that it's premature to talk about rate cuts. But unless he does that explicitly and explicitly rules out that rate cuts are not going to happen early next year, I think the market is going to look through that. The market will look through the underlying trends, which is that inflation's coming down. The Fed is transitioning forward in a way which rate cuts probably become more likely. And I think it's going to be really hard for him to push back on market pricing and the underlying dynamics in markets at the moment.
Priya Misra still with us from JP Morgan. Priya, let's get to you. You sit on the buy side. When you hear those kind of calls, 175 basis points of cuts next year, starting in June, what do you think?
I hear a lot of optimism that these rate cuts will actually allow the soft landing to continue. But I think what it somewhat misses is if the economy is slowing down, the lags work both ways. So even if the Fed does start to cut rates, financial conditions may ease, but does that actually help the economy that quickly? It might take a while. So I think, I think owning duration makes sense here. I think the curve is a little bit more tricky. Do your credit work or understand exactly what companies you're buying or what balance sheets or business models, because even if the Fed starts to cut, I think it's too optimistic to think that can engineer a soft landing. If the economy is slowing and you have non-linear, increase in the unemployment rate, it takes a lot of rate cuts. It takes rates into accommodative territory for that to actually turn growth around. So I think we may be in for another volatile year next year, as I think we parse through the economic data as well as how the Fed responds, and when do they transition from normalization rate cuts to actually accommodative rate cuts. I think that's going to be a tricky one for the Fed, because they have to realize, well, we have to actually cut a lot more than just normalize.
But to be clear here, Priya, the big shift in the last 6 months is to move from some level of restriction to now a shocking accommodation, right?
I think in real rate terms, it's harder to see that because inflation's come down a lot. So if you think about the real rate framework of how the Fed, I think, operates, policy went from very restrictive to slightly restrictive because, you've had that big decline in inflation, and the Fed hasn't, nominal rates have declined, but a lot of that has been inflation. So I think some of these rate cuts that are getting priced in are all inflation induced. I think for it to be accommodative, you have to have real rates decline. 10-year real rates are still at 2%. I think that's still well within restrictive territory.
Matt, before we let you go, I know that you did work at the Treasury Department, and I'd love you to weigh in on the awkward kind of dance between the discussion from the Treasury Department head and the head of the Federal Reserve. How much credence do you put into what we heard from Yellen about the potential of just sequential rate cuts in response to disinflation and this optimism of a soft landing, and pair that with the likely agreement with Fed Chair Powell?
Yeah, I think, the comments that we hear from Secretary Yellen in some ways are very much in line with what we heard from Governor Waller, which is that as inflation comes down, in order to ensure that policy doesn't become too tight over time, the Fed, certainly could cut rates. It's a separate question about how do you message that, when do you message that, and how do you kind of deal with the risk balance about how worried they might be about inflation picking back up again. At this meeting today, I think it's too early for Chair Powell to completely embrace that story. I think he will want to say that it's still premature to really have these discussions. The dot plot will show rate cuts, but expectations that that's not going to happen for some time. But I do think that conversation within the Fed can kind of transition relatively quickly. I think by Q1, if they continue to get positive inflation data, they could begin to more actively talk about what conditions do they need to see to cut rates, and that might be quicker than what many people think.
I think Priya was happy she didn't get that question, and Matt Lazzetti did. Hey, Matt, it's good to catch up. I know you've got to run. Matt Lazzetti over at Deutsche Bank. We are about 4.5 minutes away from that Fed decision. The state of play looks like this. Equities going absolutely nowhere. Looking for changes in the statement, changes to the projections, and looking for the tone in the news conference with Chairman Powell. Priya, I want to talk about how one-sided things have become in the last 4, 5, 6 weeks. All of a sudden, 99.9% of the people we speak to are on the same page. They're looking for rate cuts in 2024. We can have disagreement about the start time, the amount they do end up cutting, but ultimately, they're all on the same page. Priya, 6 weeks ago, it was a very different story. Do you find that unsettling?
I think end of cycles are always tricky because the data doesn't point to one clear direction, and we're all used to a forward guidance Fed, and there is no forward guidance here, and I would discount any forward guidance you get from them. So it is. Yeah, I think the narrative shifted very quickly. Remember, nobody wanted to buy treasuries to now everyone sort of falling over themselves to buy treasuries even with the move. It is disquieting, but I think it tells you that price action can be driven by positioning often. And so we have to be careful. But I think you take a step back. Is monetary policy restrictive? Yes. Is the economy slowing down? Yes. Inflation is declining. I think that's a good environment for fixed income. All the money sitting out in cash is going to start to come out and look for value.
Well, that's right where I wanted to go. Is your stunning call of price up and yield down, down, down? Is it that wall of $6 trillion cash?
There is some of that, yes, because I think, that money has it's been good to sit in cash. You earn 5%. As the Fed starts to cut rates, what about their reinvestment risk? And if the Fed's cutting 50 basis points, or, the market should price in the total amount of cuts, if we are talking 200, 300 basis points of cuts, that cash is not going to look that attractive. And that's why I think you're seeing people now thinking about where do I move out, and you start looking at valuations. I would say, high quality fixed income now is a very strong competitor to all risk assets. Yeah, and you get liquidity, you get high quality, and you get positive real rates, 2% real rates in treasuries. I think that's attractive, and I think that's one of our big calls for why, the next year, 24, is going to be a good year for fixed income as the Fed starts to cut rates. So that's why I think the narrative around Fed easing, and I think the dot plot will confirm that, is key to why money starts to move out of the front end into bond funds.
Priya, let's wrap it up. 2 minutes to go until the decision. You're going to run away back to the Bloomberg terminal in just a moment. When all this drops, what are you looking for first?
I'll be looking for a number of, you mean from the Fed, right? I'll be looking for a number of rate cuts that they're looking for next year, and the inflation, what is their forecast for inflation and growth? So sort of to get their response function.
I meant the Fed, not the bar cart, but you can go there too. Priya, thank you. Priya Misra, JP Morgan, appreciate it, Priya. I knew where you were going, TK, that's for sure. We are about 90 seconds away from that Fed decision. Equities going almost absolutely nowhere. TK, this is an interesting one for Chairman Powell.
Precisely right. This is interesting. interesting. He's really boxed in here. Talk about degrees of freedom, which is fancy for what's his choice set. What is his optionality forward? Nada this time around. He is framed in tight.
What I'm curious about is the statement of economic projections. At the previous one, they expected the year next year to end at 2.6% for core PCE. UBS did a study derived from PPI and CPI that we got this week and found that the 6-month annualized rate of that core PCE was 1.9%. So do they downgrade their expectations of where inflation is? And then how do they then pair that with a GDP call and an unemployment call? Do they then make those also more rosy? No. It's just, that's
we
really
got to
where
get to
we
the
are.
announcement. When I hear the word expectations, all my radar goes up. They don't expect. They react to the data. They react to what we're going to see in 20 seconds, John.
And then Chairman Powell's got to try and clean it all up in about 30 minutes' time and 20 seconds. 20 seconds away from the Fed decision. The scores look like this going into it. The equity market just about positive by 0.1% on the S&P 500, up 0.1% on the Nasdaq. In the bond market, your 2-year yield shaping up as follows: the 2-year 4.66, the 10-year 4.15. With your Fed decision, here's Mike McKee.
Doves fly at the Fed as officials signal they are done raising rates, instead raising the number of rate cuts they see next year. Officials left the overnight rate unchanged at 5.25% to 5.5%, but they essentially confirmed that's it. The money quote from the statement gets a one-word addition. In determining the extent of any additional policy firming that may be appropriate to return inflation to 2%. The dot plot, meanwhile, sees 75 basis points of cuts next year, one more move than they saw in September. The dispersion is wide, however, with 8 seeing fewer than those 3 cuts, 5 seeing more than 3. In 2025, they see an additional 4 rate cuts, 1 down from September, and 2 more in 2026. The longer-run neutral rate remains at 2.5%. Their move comes as they significantly lower their median headline inflation forecast this year to 2.8%. As the statement notes, inflation has eased over the past year, but remains elevated. In the median forecast, it falls further in 2024 to 2.4%, 2.1% in 2025, and 2% finally in 2026. Core PCE inflation, 3.2% this year, down from September's forecast of 3.7%. It keeps falling, hitting 2% also in 2026. The statement says, quote, growth of economic activity has slowed from its strong pace in the third quarter, but they still revised their median forecast for GDP growth this year significantly to 2.6% from 2.1% in September. It falls to just 1.4% next year. Potential growth in the longer run is seen at 1.8%. No change in their unemployment forecast of 3.8% this year, which implies the jobless rate moves up in December because it's 3.7% right now. The next 3 years, the median unemployment rate will come in at 4.1%. The decision, guys, again, unanimous.
Mike McKee, thank you, sir. Let's make it very simple. The 2024 dot, implying 3 cuts next year from this Federal Reserve. It doesn't meet the market, but it closes the gap and endorses the direction of travel over the last 4 to 6 weeks. In the bond market, this is what's falling right now. Yields and falling hard. We're down 19, call it 20 basis points lower at the front end of the curve. On a 2-year, 4.53. On a 10-year, down 13 at 4.07%. Once you figure out where the bond market is, take a guess where the FX market is. The dollar looks a little something like this. Against the euro at the moment, weaker. The euro stronger, 108.45. And if you're looking at equities, we endorse a move higher, up by 0.5% this morning on the S&P 500, up again this afternoon on the Nasdaq by 0.4%. Lisa, the rally moves on.
We could end up getting a sub 4% 10-year yield by the end of this trading session as people parse through this. To me, the fact that this is unequivocally dovish, that they endorse the Fed's idea the market's idea of rate cuts and then some really speaks to a question of, is there going to be cleanup act on aisle one, or is this going to be Fed Chair Powell saying, we're just responding to the data in front of us and it looks pretty good?
Well, we talk about, Tom, the risk, the potential of being whipsawed by Chairman Powell in about 27 minutes' time. The early take, and we'll see if it sticks, the early take is this. Ultimately, you're looking for 3 cuts next year. Our 4 or 5 cuts no longer sounds that ridiculous. Now you come closer and closer to where we were before.
No hedging here. I was going back and forth with a professor at the University of Cambridge, and 2 standard deviations down on 10-year yield. John, we almost came to it. We came very, very close to it. 4.08%, 4.07 at 4.6. We'll have to see what plays out with the press conference, but this is frankly more than we expected. We also expect wonderful conversation at this moment with Diane Swank. She's chief economist at KPMG. Diane, you know the interest space is the litmus paper of our economic and our Fed system. Are we seeing a constructive reduction in yields, or does this signal slower economic growth?
Well, I think what we're seeing is that the bond market is leaning into the concept of the fact that inflation has plummeted so rapidly. I think this is a full inflation story. There's no question that the Fed has showed its cards here. They're very excited about the fact that inflation has come down at its fastest pace outside of World War II, the Korean War, and the Volcker recessions. That is really stunning, given we've not seen a major increase in unemployment with that, and they're feeling good about it. And I think you're going to see some of that euphoria from Chairman Powell as well. It's more than we expected. It is important to remember last time they had a rate hike before the end of the year. So just by removing one rate hike out of it, that puts one more cut into 2024 as well. And I think that sort of nuance is lost in translation, but it is part of the story as well, is they're not really backing off higher for a period of time. The next question is higher for how long?
Some big moves.
I think we might be close to higher for long enough.
Some big moves in this bond market right now. We're down 17 basis points on a front end on a 2-year at 4.56, on a 10-year down 11 to 4.09%. Alongside Dan Swank, I'm pleased to say Greg Peters of PGIM jumps in front of the camera. Greg, let's talk about it. In about 24 minutes' time, Chairman Powell has an opportunity to clarify some of this. Do you think he needs to?
Well, I'm not sure there's much he can do at this point. I mean, the market just absolutely loved this result. I thought the market was already leaning a little too much. Evidently, that wasn't the case. We weren't leaning enough. So, doves fly and bulls run after this. And I think it's really hard for Powell to put that genie back in the bottle.
Does that give you a sense, doves flying and bulls running, the idea of FOMO and just how much that's taken over the market after so many people missed out on 5% 10-year yields?
I think that's just an artifact of the current market, right? I mean, the markets are much more volatile. They move much more powerfully. I think that's just the construct, right, with CTAs and algos and other sorts of things. And I think this is the world that we live in, honestly. So I don't think this is a unique feature anymore. I think this is quite commonplace.
Diane Swank, I did the nominal GDP math here on the inflation guesstimate and the growth guesstimate, and boy, it sure looks to me like a 4% nominal GDP, even south of that, modeled out over the next 24 months. How do our viewers and listeners react to that if our animal spirit post-pandemic diminishes down sub 4%?
We know what's interesting about it is that also the part that we didn't talk about in the SEPs is that the Fed's long-term estimates of what the neutral rate on the Fed funds rate, if you look at their ranges, that has actually continued to move up. And so I think what you're seeing here is that an economy that the Fed expects to cool below potential, unemployment to come up a little bit, although we might not, the consumer's really taken everything the Fed's tried to deal them and, taken it with stride and kept on going. And I think that may mean some upside risk to the economic growth side of this situation. But it's really interesting that the Fed's terminal rates now look like they're starting to move up even more than they were last time. And that seems to have gotten lost in translation. That's not what the market's focused on right now. But I think the Fed is looking at an economy that's more resilient and that will take off more rapidly as rates come down.
Does that cohere with what you think, that basically we're talking about a higher new neutral rate as we have no landing or a very, very soft one?
Exactly. I think we are at a higher non-inflationary rate, and I think that's something you see it just in the slowness with which the Fed puts out its cuts and not getting back. The descent on rates is not as rapid as the ascent on rates, and the need, you see it in their long-term forecast. Even as all this good news has come in, and it's really shifted the narrative in terms of, we were trying so hard to get up to an inflation target for so long. The Fed does still believe that we're in a world, and it sort of was illustrated by the volatility in the bond market we were just talking about, that we're in a world that's more susceptible to external shocks than it once was. We've also gotten incredibly good news on oil prices coming down, helping to spill over into inflation. All of that's great. It doesn't mean that we're going into the world of subpar growth, of inability to get inflation up that we left in the 2010s. We have healed balance sheets, except for the federal government, quite significantly since then. And I think that's where the paradigm shift is.
Diane, let's go through the projections together. The median for 2024, GDP 1.4%, unemployment 4.1%. Core PCE, 2.4, Fed funds, 4.6. Diane, not so long ago, you and I used to talk about this being aspirational. How realistic is it now?
It now seems entirely possible, and you know what? More things than I can list have surprised me about this economy, and this is not where we thought we'd be, but how glorious it is that we're here. It's not been easy. It's not as if interest rate sectors aren't feeling pain. They are. The housing market is still stuck in a mortgage winter, even though rates are coming down. This will help unlock some demand, but prices are still too high, and the supply of homes is still too much in a shortage, especially in the single-family home market. So we know there's still strains in this economy, but the good news is we didn't have to get here without the kind of pain that, I think back on that speech, 8 minutes, 34 seconds, August 2022. It was like a bucket of ice, where the Chairman Powell really believed we would have to go through a recession in order to rid ourselves of this inflation. And that's just not been the case. Much more of it was supply chains uncurling and the problems that we had there, along with some time to let the production pick up with demand. And I think that's important.
Otherwise known as transitory, just not called transitory. Greg, can you buy into this? This sense that we're
transitory over a much longer period of time.
Greg Peters, can you weigh in a little bit on whether you think this is plausible, or whether you would lean against this right now, or whether you would actually even sell and wait for a better buying moment?
I mean, I do think the markets are really pushing the limits here. There's so much good news being priced in, whether it's inflation, whether it's growth. The yield curve is still inverted, right? And so, how do you reconcile the fact that investors are feeling really good about the growth outlook, inflation's coming down, and the curve's inverted? And so I think there's still some repricing ahead. I think there's still quite bumpy elements in the road ahead. So, I'm kind of thinking the market is really taking this to the brink here, and I would be inclined to go the other way.
Greg, I'm looking at money market funds 5% and all the other stuff we blather about each and every day. And I know we get convexity in the stock market. Do we get convexity in the bond market? When I got a 10-year real yield popping to 1.91, I got the 10-year yield on minus 2 standard deviations, right down on 4.06%. Can there be such a thing as momentum in the bond market, price up, yield down?
Yeah, I think you're seeing it, Tom. I mean, if you look at the total return in the bond market over the past month or so, it's been, quite astounding, right? Anywhere from 5 to, 8%. That's real money, right? And so you've seen it. And so there has been some quote unquote positive convexity, just given the low level of prices, right? But the real question is not what happened, but where are we going? And so, once again, I worry about, the current market really squeezing a lot of the total return out of the market way too soon.
Well, look at the move this afternoon. It's a monster move. We're down almost 20 basis points at the front end of the curve. Allow me to share a quote with you. It would be premature to conclude with confidence that we have achieved a sufficiently restrictive stance or to speculate on when policy might ease. Chairman Powell, not even 2 weeks ago, on December 1st, Diane Swong, in 15, 16, 17 minutes' time when we hear from the chairman again, why would the message be any different?
Well, I think he's still going to be cautious in his messaging, but you saw a little bit of the lightness in his step when we saw the bond market rally November 1st, even though we had what was a hawkish set of, in September, a hawkish outlook. By November 1st, you saw the market unwind significantly since then because of how euphoric and a little bit excited that Chair Powell was in that press conference. And so I think it's going to be hard for him to walk back a lot at this point in time. I think it would do him good to be cautious and to be a little bit, contingent on, we're excited, but here's the risks. But I think it's going to be hard given they signed off on this statement and they signed off on this forecast, and this is about as dovish as we could have expected. This is more than I expected in terms of dovishness, and I think it's hard for him to walk it back, and I don't think he would be walking it back all that much given the fact that they all signed off on it.
Which is the reason why you're seeing
he's not going to add to it, but he's not going to push back too much.
Which is the reason why, and it's a good point, that you're seeing an 18 basis point drop in the 2-year yield as time goes on, 4.54%. Greg, you said you'd push back against this. The market's really taking this to the brink. What makes you feel that way? And what could you hear from Chair Powell that could change your mind?
Well, so I'm not sure I'm going to hear much from Chair Powell. As I mentioned, I think the genie's out of the bottle. I think it's hard to walk this back. I think at some level he is quite pleased, and rightfully so, right? They've seen a tremendous amount of disinflation come through during the course of this year, and that's something to be proud of. But I guess just from a market pricing fixed income perspective, do we really want to be in an environment where we're taking down yields so aggressively, where we're basically have to see these rate cuts come through and then some in order to achieve total return? So, to me, it's just a balance about risk reward and what's embedded in the price. And I think, quite frankly, there's a lot of good news embedded in the price. And that's always something that you should, take a step back.
A ton of good news priced in over the last month. Greg Peters, Diane Swong, two of the very best going into this Federal Reserve news conference with Chairman Powell in about 14 minutes' time. Thanks to both of you. Let's talk about these moves. No big changes to that statement. No change in the decision, but some monster changes to the projections. Take 2024, for instance. Fed funds, median dot, now 4.6%. Back in September, that was 5.1. This is a Fed, it's a median dot, implying that maybe 3 cuts are in our future from this Federal Reserve. The market may be 50 basis points lower than that, but ultimately, Lisa, we've closed the gap and we've endorsed the direction of travel over the last 6 weeks, which is why you've got this monster move again on a 2-year by 19 basis points of 453. So if you don't stop the direction, if you don't stop the momentum, what happens? You do more of the same, don't you, Lisa? Isn't that what's happening?
Which is what Priya Misra said, that this was the asymmetry. And this is what Greg Peters, as well as Diane Swong, both said, which is it was more than they expected and certainly more than the market expected, and the market is cheering. Basically, this message is that Chair Powell cannot walk this back. The rest of the Fed members put this in, so he either leans in, he either gives an explanation of weakening in the economy that isn't seen in the projections, or he kind of equivocates and basically is, circling around with his tail.
Neil Dutta, Renaissance Macro, super modest. Do you want the quote? Complete vindication of a March cut. 95 is a good analog. Surgical cuts are coming. Buckle up. Risk appetite has room to run. Wow, did he nail it? He nailed it for sure. Check out the scores going into the news conference on the S&P 500, 4th day of gains on the cards. Unless Chairman Powell messes that up for you. On the S&P 500, up by 0.6% on the S&P into the bond market. I know we've seen some big moves in fixed income, but These are big moves again. We're down 20 basis points on a 2-year, 453.53. We'd seen big moves coming into today's decision. We're down large again. We're down 12 on a 10-year at 4.08%. Let's continue the conversation with Bank of America's Michael Gapin, Subhadra Japa of SocGen. Subhadra, first to you. You've had some time to chew over this one. What's your take on it?
Yeah, definitely the dovishness in the dots caught me by surprise. But I think it seems like they're looking at inflation starting to come down. Maybe they're looking at 3-month and 6-month moving averages and doing exactly what they did a couple of years back when they were looking at 3-month and 6-month moving averages, which were running a lot harder than the market, and so they had to come in and start hiking. So I think you're looking at a very similar scenario here, where they're willing, it seems, to adjust policy given the data that we have right now on inflation.
Michael Gapin, thrilled to have you with us, particularly with the reach of the Bank of America across all of America, the consumer, the pulse of our 70% consumption. Do you buy this idea of the massive potential GDP slowdown of the next 2 years, sub 2% real GDP, inflation that's quiescent, nominal GDP that's 4% if we're lucky? Is that the evidence that the Bank of America sees?
On balance, yes. So our B of A card data has been showing resiliency in consumer spending and pretty good holiday spend. So our view is the slowdown, if we get one, is going to come in your non-consumer related components, business spending, the fiscal drag, and so forth. We think it's possible. We think the narrative around the idea that you don't need as much labor market pain to bring inflation down, the data is kind of confirming that, and it matches with what we're seeing from our card data and around the health of the consumer. So yes, the economic activity should moderate, even personal consumption spending should slow. But we've gotten a lot of evidence here now over the past few months that maybe we don't need to crimp demand as much to return inflation to 2%, and we can allow some of these supply side factors, whether it's supply chain or the rebound in the labor force, to help us out.
Michael, could this rip-roaring rally go against that? Could it make it more difficult to achieve the actual end of the soft landing by rejuvenating certain demand and rejuvenating animal spirits?
Possibly, but I think, the Fed kind of modulates demand, right? That they don't really control the supply side as much. And so I think what the balance here is to say, okay, maybe demand picks up a little bit, but that's probably more about the timing of the cuts and the pace of the cuts and that end terminal rate rather than the direction of travel. So yes, there's a risk that things would ease too quickly. The Fed prejudges this and they have to come back later and backtrack. That's going to be around the wait and see and how much confidence that they have in order to start a cutting cycle. But I think that's more about the timing and the pace of cuts than it is about having to backtrack.
Subhadra, you and many other people were expecting hawkish pushback. That was actually the consensus belief coming into this meeting. Does anything about this statement make you rethink how you would respond to this? That basically, load the boat, FOMO is on, let's go.
Yeah, no, definitely. I mean, I think the FOMO trade's already happened, right? We've had 10-year yields decline from 5% all the way down to now close to 4% in a very short amount of time. I think I would have to agree with the statement you read from Neil Dutta earlier, which is maybe the market is looking towards a much more of an adjustment in policy as we go along, modus operandi from the Fed. I mean, that's not our view. We still think that the Fed is going to keep policy on hold at least till May, till they see a very clear signal that inflation is trending towards their 2% target. And we think that the economy, broadly speaking, should hold up until that point. Because once we get to that point, I think the Fed can very quickly cut rates in a very short amount of time if there is a meaningful slowdown. The risk is that if they deliver these cuts too soon, then you could see perhaps a resurgence of this sort of services side inflation that we've been experiencing over the last couple of years.
John, I'm going to predict that everybody's going to go in and they're going to blow up their call. They're going to blow up their year-end outlook. I hear all this good talk. I think Michael Gapin is absolutely dead on.
You think it gets more bullish than it already
resilient. It's not that it's both. This is really, really important. This goes back to Diane Swank, Gina Martin Adams, and others. This, to me, is far more a real economy analysis, redounding back to these dynamics. In the last 2 minutes, John, I got a 407 retest of the 10-year yield down 13 beeps. If that puppy breaks through 4.06, that is a massive signal that everybody has to rip up the script this afternoon.
We joked earlier this morning that if the party started at the end of October, Governor Waller bought the tequila in the last couple of weeks. Yeah. It's not him I don't think we need to talk about. I think we need to be talking about New York Fed President John Williams. Mike, I remember when President Williams, a number of months ago, engaged a conversation about reducing interest rates as inflation continued to fall, just to keep real rates stable and to ensure that things didn't become tighter over time. Is it too early, too premature for Chairman Powell to engage in that type of conversation in this news conference?
I don't. I mean, maybe I'm a bit of a contrarian here because we thought the median dot would come in at 4.6. We expected a shift in communication. So what I'm hearing today so far is in line with what I thought. So I do think it would be a proper first step to get out of a hawkish bias and a hiking bias, and then start getting into a world of, talking at least about a more balanced reaction function, not ruling out hikes, but also talking about conditions under which you might ease. You have to start moving in that direction. Inflation, at least at the moment, is decelerating fast enough where it's not crazy to think you could cut in March if you're a committee member based on inflation alone. So there's not a lot of time to prepare between now and then. So it's something I think you do need to entertain.
Subhadra, I'm curious your view on something we were hearing from Diane Swank, that this sort of soft landing implies actually a higher long-term neutral rate, that essentially there is more strength in this economy that can handle rates at a higher level. Are you seeing that within some of these projections and kind of adjusting your expectation just for that base of where the Fed's going to ultimately cut to?
Yeah, that's I completely agree with that. I mean, our view is that the Fed will cut rates by 150 basis points next year, and there will be more cuts in 2025 with the Fed funds rate getting a little bit north of 3%. So that's pretty much getting down to where they have their long-run neutral rate of 2.5%. So that sort of trajectory makes sense. The question really is, what does the curve do under those circumstances? Right. And that's really where I feel like there's the story of the rebuild in term premium is still very much in play, because the demand dynamics are still very skewed. We still have a decent amount of supply, and I think that could lead to a meaningful steepening of the curve while the cutting happens.
Subhadra, to the heritage of derivatives at SocGen, where I have no idea where this happens, but if we have what is it, Lisa? The money market fund now, 5 point what?
Well, 5.33 is 5%, right?
At what point, Subhadra, if we bring the money market fund down, does a wall of money try to find a new warm place?
Yeah, that's the risk, right? We have almost $6 trillion in money market funds. That money, if the returns are not attractive, are going to try to migrate towards other parts of the yield curve. Or
give me a level. I mean, Subhadra, this is so important. Is this going to happen at 4.8%? Do we got to wait for 3.8%? When is the money market game over?
Well, when the curve disinverts, perhaps. At the current time, 2-year yields is still higher than where 10-year yields are. And so you're going to see money continue to flow into the very front end of the yield curve. At some point, I think that when the market, when cuts have been, sufficient cuts have been delivered and it's been stimulative, I think that you're going to see that money migrate towards risky assets or other higher yielding assets. But at the current time, with the curve inverted, I think that the front end still looks quite attractive to us on a duration adjusted basis.
Let's play questions for Chairman Powell. The news conference about 3 minutes away. Michael Gapin, what would you ask today?
I would ask kind of one question would be what you're referencing, essentially, what's the purpose of the cutting cycle? To get policy easy, to track a real rate of interest that you think is appropriate? If so, what's that rate? The second I would ask him, is policy really restrictive? What evidence outside of housing do you have to suggest that policy is currently restrictive? So that'd be a bit of a counterfactual to to his view. And otherwise, the third question I'd ask is, is it feasible, just to make it clear, is it feasible to cut on the inflation data alone, or do you need to see weakness in activity in the labor market? Those are three I would pose.
You don't get three, Mike. You're lucky if you get two. If you're Mike McKee, you're lucky if you get one. Subhadra, give us the final word. What would you ask today?
I'd be curious to see if the Fed would be inclined to deliver sort of, adjustments in policy like they did back in the 90s, because that's something that the market is looking towards, is perhaps they adjust, they stay on hold, and then they cut some more if needed. So it's not sort of your conventional cycle. I think, to me, that's a very underpriced risk in the market, is a 90s-style rate cut cycle.
Subhadra Japa, Michael Gapin, to the two of you, thank you. Just brilliant, as always. Michael Gapin over at Bank of America, back in a seat and good to see. Absolutely nailed it. Looking for 3 cuts to go into that median dot in 2024. And Lisa, I think he's right to talk about not just dates, but thresholds. What is the bar? Where is the bar for when you start to deliver those cuts? What are you looking for? And now you've priced that, implied that in your projections. Haven't they got to engage in that conversation over the next hour?
Yeah, is lower inflation enough, right? Just by de facto, or do they have to see some other sort of weakness? And what are the parameters? What are the levels? These are important questions. I also just think that right now, what's he going to say other than just read it? And we've got some sort of new sense that we are disinflating, and it's a positive thing, and we'll be vigilant and watch it and go with where we think it's appropriate.
As I heard from our guests, they did not expect this. I did not expect this. This is a sea change shift back to the regime pre-pandemic. And John, you nailed it, bringing up John Williams and the idea months ago of a shocking reset to the R-star before the pandemic. And today is a massive shift, a sea change moment in terms of getting beyond the pandemic.
I went over this quote a little bit earlier this morning. And as we take the pictures and wait to see Chairman Powell enter that room in Washington, D.C., I want to reflect on the quote of Chairman Powell's not even 2 weeks ago. It would be premature to conclude with confidence that we have achieved a sufficiently restrictive stance or to speculate on when policy might ease. Lisa, you wonder what changed in the last 2 weeks?
Omar Sharif of Inflation Insights actually put out that quote just moments ago, and it says, it turns out it wasn't premature at all. And so if that's the case, what has shifted? Was it the CPI and the PPI data? Can he say there just has been enough cumulative data to suggest that this is a trend and not necessarily a one-off?
I'm watching for Chairman Powell here on Bloomberg Radio, and I would say, Lisa, that what's so important here is the massive street short cover of many different asset classes of people that got this wrong. We have, as we speak, in this press conference, many 2 standard deviation moves. That's not expected.
You think we're still covering those shorts after the move we've seen over the last month?
This is a reshort, precisely right. John, somebody's stepping up.
The chairman of the Federal Reserve. Let's take a listen.
Good afternoon. My colleagues and I remain squarely focused on our dual mandate to promote maximum employment and stable prices for the American people. As we approach the end of the year, it's natural to look back on the progress that has been made toward our dual mandate objectives. Inflation has eased from its highs, and this has come without a significant increase in unemployment. That's very good news. But inflation is still too high, ongoing progress in bringing it down is not assured, and the path forward is uncertain. As we look ahead to next year, I want to assure the American people that we're fully committed to returning inflation to our 2% goal. Restoring price stability is essential to achieve a sustained period of strong labor market conditions that benefit all. Since early last year, the FOMC has significantly tightened the stance of monetary policy. We've raised our policy interest rate by 5.25 percentage points and have continued to reduce our securities holdings at a brisk pace. Our actions have moved our policy rate well into restrictive territory, meaning that tight policy is putting downward pressure on economic activity and inflation, and the full effects of our tightening likely have not yet been felt. Today, we decided to leave our policy interest rate unchanged and to continue to reduce our securities holdings. Given how far we have come, along with the uncertainties and risks that we face, the committee is proceeding carefully. We will make decisions about the extent of any additional policy firming and how long policy will remain restrictive based on the totality of the incoming data, the evolving outlook, and the balance of risks. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has slowed substantially from the outsized pace seen in the third quarter. Even so, GDP is on track to expand around 2.5% for the year as a whole, bolstered by strong consumer demand as well as improving supply conditions. After picking somewhat over the summer, activity in the housing sector has flattened out and remains well below the levels of a year ago, largely reflecting higher mortgage rates. Higher interest rates also appear to be weighing on business fixed investment. In our summary of economic projections, committee participants revised up their assessments of GDP growth this year, but expect growth to cool, with the median projection falling to 1.4% next year. The labor market remains tight, but supply and demand conditions continue to come into better balance. Over the past 3 months, payroll job gains averaged 204,000 jobs per month, a strong pace that is nevertheless below that seen earlier in the year. The unemployment rate remains low at 3.7%. Strong job creation has been accompanied by an increase in the supply of workers. The labor force participation rate has moved up since last year, particularly for individuals aged 25 to 54 years, and immigration has returned to pre-pandemic levels. Nominal wage growth appears to be easing, and job vacancies have declined. Although the jobs-to-workers gap has narrowed, labor demand still exceeds the supply of available workers. FOMC participants expect the rebalancing in the labor market to continue, easing upward pressures on inflation. The median unemployment rate projection in the SEP rises somewhat from 3.8% at the end of this year to 4.1% at the end of next year. Inflation has eased over the past year, but remains above our longer-run goal of 2%. Based on the Consumer Price Index and other data, we estimate that total PCE prices rose 2.6% over the 12 months ending in November, and that, excluding the volatile food and energy categories, core PCE prices rose 3.1%. The lower inflation readings over the past several months are welcome, but we will need to see further evidence to build confidence that inflation is moving down sustainably toward our goal. Longer-term inflation expectations appear to remain well anchored, as reflected in a broad range of surveys of households, businesses, and forecasters, as well as measures from financial markets. As is evident from the SEP, we anticipate that the process of getting inflation all the way to 2% will take some time. The median projection in the SEP is 2.8% this year, falls to 2.4% next year, and reaches 2% in 2026. The Fed's monetary policy actions are guided by our mandate to promote maximum employment and stable prices for the American people. My colleagues and I are acutely aware that high inflation imposes significant hardship as it erodes purchasing power, especially for those least able to meet the higher costs of essentials like food, housing, and transportation. We're highly attentive to the risks that high inflation poses to both sides of our mandate, and we are strongly committed to returning inflation to our 2% objective. As I noted earlier, since early last year, we have raised our policy rate by 5.25 percentage points, and we have decreased our securities holdings by more than $1 trillion. Our restrictive stance of monetary policy is putting downward pressure on economic activity and inflation. The committee decided at today's meeting to maintain the target range for the federal funds rate at 5.25 to 5.5%, and to continue the process of significantly reducing our securities holdings. While we believe that our policy rate is likely at or near its peak for this tightening cycle, the economy has surprised forecasters in many ways since the pandemic, and ongoing progress toward our 2% inflation objective is not assured. We are prepared to tighten policy further if appropriate. We're committed to achieving a stance of monetary policy that is sufficiently restrictive to bring inflation sustainably down to 2% over time, and to keeping policy restrictive until we're confident that inflation is on a path to that objective. In our SEP, FOMC participants wrote down their individual assessments of an appropriate path for the federal funds rate based on what each participant judges to be the most likely scenario going forward. While participants do not view it as likely to be appropriate to raise interest rates further, neither do they want to take the possibility off the table. If the economy evolves as projected, the median participant projects that the appropriate level of the federal funds rate will be 4.6% at the end of 2024, 3.6% at the end of 2025, and 2.9% at the end of 2026, still above the median longer-term rate. These projections are not a committee decision or plan. If the economy does not evolve as projected, the path of policy will adjust as appropriate to foster our maximum employment and price stability goals. In light of the uncertainties and risks and how far we have come, the committee is proceeding carefully. We will continue to make our decisions meeting by meeting based on the totality of the incoming data and their implications for the outlook for economic activity and inflation, as well as the balance of risks. In determining the extent of any additional policy firming that may be appropriate to return inflation to 2% over time, the committee will take into account the cumulative tightening of monetary policy, the lags with which monetary policy affects economic activity and inflation, and economic and financial developments. We remain committed to bringing inflation back down to our 2% goal and to keeping longer-term inflation expectations well anchored. Restoring price stability is essential to set the stage for achieving maximum employment and stable prices over the longer run. To conclude, we understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thank you. Chris Rugaber at Associated Press. I wanted to ask, how should we interpret the addition of the word any before additional firming in the statement? I mean, does that mean that you're pretty much done with rate hikes and the committee has shifted away from a tightening bias and toward a more neutral stance? Thank you.
So, specifically on any, we do say that in determining the extent of any additional policy firming that may be appropriate, so any additional policy firming, that sentence. So we added the word any as an acknowledgement that we believe that we are likely at or near the peak rate for this cycle. Participants didn't write down additional hikes that we believe are likely, so that's what we wrote down. But participants also didn't want to take the possibility of further hikes off the table. So that's really what we were thinking.
Mr. Chairman, the microphone, sorry. Steve Leisman, CNBC. Happy holidays, Mr. Chairman. Fed Governor Chris Waller said that if inflation continues to fall, then the Fed in the next several months could be cutting interest rates. I wonder if you could comment on whether you agree with Fed Governor Waller on that the Fed would become more restrictive if it didn't cut rates if inflation fell. Thank you, sir.
So, of course, I don't comment on any other officials, even those who work at the Fed. But I'll try to answer your question more broadly. So the way we're looking at it is really this. When we started out, right, we said the first question is how fast to move, and we moved very fast. The second question is, really how high to raise the policy rate, and that's really the question that we're still on here. We're very focused on that. As I mentioned, people generally think that we're at or near that, and think it's not likely that we will hike, although they don't take that possibility off the table. So that's when you get to that question, and that's your answer. There's a naturally it begins to be the next question, which is when it will become appropriate to begin dialing back the amount of policy restraint that's in place. So that's really the next question, and that's what people are thinking about and talking about. And I would just say this. We are seeing, strong growth that appears to be moderating. We're seeing a labor market that is coming back into balance by so many measures, and we're seeing inflation making real progress. These are the things we've been wanting to see. We can't know. We still have a ways to go. No one is declaring victory. That would be premature. And we can't be guaranteed of this progress. So we're moving carefully in making that assessment of whether we need to do more or not. That's really the question that we're on. But of course, the other question, the question of when will it become appropriate to begin dialing back the amount of policy restraint in place, that begins to come into view. And is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
Can you give some color as to the nature of that discussion today? Thank you.
Sure. So it comes up in this way today. Everybody wrote down an SEP forecast, so many people mentioned what their rate forecast was. There was no back and forth, no attempt to sort of reach agreement, like this is what I wrote down, this is what I think, that kind of thing. And a preliminary kind of a discussion like that. Not everybody did that, but many people did. And I would say there's a general expectation that this will be a topic for us looking ahead. That's really what happened in today's meeting. I can't do the head count for you in real time, but that's generally what happened today.
Go to Rachel.
Hi, Chair Powell. Rachel Siegel from the Washington Post. Thanks for taking our questions. At this point, can you confidently say that the economy has avoided a recession and isn't heading for one now? And if the answer is no, I'm curious about what you'd still be looking for. Thanks.
I think you can say that there's little basis for thinking that the economy is in a recession now. I would say that. I think there's always a probability that there will be a recession in the next year, and it's a meaningful probability no matter what the economy is doing. So it's always a real possibility. The question is it? So it's a possibility here. I have always felt since the beginning that there was a possibility, because of the unusual situation, that the economy could cool off in a way that enabled inflation to come down without the kind of large job losses that have often been associated with high inflation and tightening cycles. So far, that's what we're seeing. That's what many forecasters on and off the committee are seeing. This result is not guaranteed. It is far too early to declare victory. And there are certainly risks. It's certainly possible that the economy will behave in an unexpected way. It has done that repeatedly through in the post-pandemic period. Nonetheless, where we are is we see the things that I mentioned.
I'm curious if you're looking back on the past year, you talked about navigating by the stars under cloudy skies. Can you talk about some of the ways in which the economy surprised you most this year, where you thought it would behave in one way and had to pivot to respond? Thanks.
So I think forecasters generally, if you go back a year, were very broadly forecasting a recession for this year, for 2023. And not only did that not happen, that includes Fed forecasters and really essentially all forecasters. A very high proportion of forecasters were expecting very weak growth or a recession. Not only did that not happen, we actually had a very strong year. And that was a combination of strong demand, but also real gains on the supply side. So this was the year when labor force participation picked up, where immigration picked up, where the distortions to supply and demand from the pandemic, the shortages and the bottlenecks really began to unwind. So we had significant supply side gains with strong demand, and we got what looks like a 2.5% plus, or a little more than that, growth year at a time when potential growth this year might even have been higher than that, just because of the healing on the supply side. So that was a surprise to just about everybody. I think the inflation forecast is roughly what people wrote down a year ago, but in a very different setting. And I would say the labor market, because of the stronger growth, has also been significantly better. If you look back at the SEP from a year ago, there was a significant increase in unemployment. That didn't really happen. We're still at 3.7%. So we've seen strong growth, still a tight labor market, but one that's coming back into balance with support from the supply side, a greater supply of labor. It's that's what we see, and that I think that combination was not anticipated broadly.
Howard.
Thanks, Howard Schneider with Reuters, and thanks for taking the questions. I wonder if you could give a little more color or detail on what motivates the lower rates next year, whether it's a coincidence, for example, that the spread between PCE inflation, core inflation, and the federal funds rate stays constant over the year. Are you simply calibrating against the fall in prices, in the price level that you're in the rate of inflation that you're expecting, as opposed to supporting the economy?
Nothing quite that mechanical is happening. The SEP really is a bottoms up, built from the bottom up, right? So I think people are looking at what's happening in the economy, and I think if you look at the big difference from September in the SEP, the expectations for inflation this year, both headline and core, have come down, really significantly in 3 months. That's a big piece of this. At the same time, growth is turned out to be very strong in the third quarter, is slowing, we believe, as appropriate. And we've had several labor market reports which suggest, again, significant progress toward greater balance across a broad range of indicators. You're seeing so many of the indicators coming back to normal, not all of them. But so I think that people look at that and they write down basically each individual writes down a forecast and a rate forecast that goes with that forecast. We tabulate them and publish it. And so it isn't, you ask about real rates, I take it, that is something that we're very conscious of and aware of and monitor, and it's certainly a big part of, it's a part of how we think about things, but really it's broader financial conditions that matter, and as you well know, it's so hard to know exactly, what the real rate is or exactly how tight policy is at any given time. So you couldn't follow that like it was a rule and think that you would get the right answer all the time. But it's certainly something that we're focused on. And indeed, if you look at the projections, I think the expectation would be that the real rate is declining as we move forward.
It sounds like the discussion over that, if I could follow up, has already kind of begun. I'm wondering, just related to Steve's question, how the tactics of this play out, given the slowing of inflation and the fact that the deeper you get into 2024, the closer you get to a presidential election. Do you want to front load this, in other words?
Yeah, no, we don't think about political events. We don't think about politics. We think about what's the right thing to do for the economy. The minute we start thinking about those things, we just can't do that. We have to think, what's the right thing? We'll do the things that we think are right for the economy at the time when we think is the right time. That's what we'll always do. So I mentioned we're moving carefully. One of the things we're moving carefully about is that decision over, that assessment really over whether we've done enough, really. And you see that people are not writing down rate hikes. That's us thinking that we have done enough, but not feeling that really strongly, confidently, and not wanting to take the possibility of a rate hike off the table. Nonetheless, it's not the base case anymore, obviously, as it was, 60, 90 days ago. So that's how we're approaching things. And as I mentioned, we wrote down this SEP, and it talks about people have individual assessments of when it will be appropriate to start to dial back on the tight policy we have in place. And that's a discussion we'll be having going forward, but that's another assessment that we're going to make very carefully, so as time goes forward.
Nick Timmeros of the Wall Street Journal. Chair Powell, you've argued over the last year that policy tightening started before you actually lifted off because the market anticipated your moves and tightened on your behalf. The market is now easing policy on your behalf by anticipating a funds rate by next September that's a full point below the current level, with cuts beginning around March. Is this something that you are broadly comfortable with?
So this last year has been remarkable for the sort of seesaw thing back and forth we've had over the course of the year, of markets moving away and moving back and that kind of thing. So, and what I would just say is that we focus on what we have to do and how we need to use our tools to achieve our goals, and that's what we really focus on. And people are going to have different forecasts about the economy, and those are going to show up in market conditions, or they won't, but in any case, we have to do what we think is right. And, in the long run, it's important that financial conditions become aligned or are aligned with what we're trying to accomplish. And in the long run, they will be, of course, because we will do what it takes to get to our goals. And ultimately, that will mean that financial conditions will come along. But in the meantime, there can be back and forth, and I'm just focused on what's the right thing for us to do, and my colleagues are focused on that too.
The markets seem to think inflation is coming down credibly. Do you believe we're at the point where inflation is coming down credibly?
Listen, I welcome the progress. I think it's really good to see the progress that we're making. I think if you look at the 12-month measure, look at the 6-month measures, you see very low numbers. If you look at 12-month measures, you're still well above 2%. You're actually above 3% on core through November at PCE. That isn't to say I'm not calling into question the progress. It's great. We just need to see more. We need to see continued further progress toward getting back to 2%. That's what we need to see. So. It's our job to restore price stability, and that it's one of our two jobs along with maximum employment, and they're equal. So we're very focused on doing that. As I mentioned, we're moving carefully at this point. We're pleased with the progress, but we see the need for further progress. And I think it's fair to say there is a lot of uncertainty about going forward. We've seen the economy move in surprising directions, so we're just going to need to see more further progress.
Gina Smilik, New York Times. Thanks for taking our questions. In the SEP from today, growth is notably below potential in 2024. If growth were to surprise us again in the way that it has for years now by being stronger than expected next year, would it still be possible to cut rates? Or put another way, is below trend growth necessary to cut rates, or would continued progress on inflation alone be sufficient? So
we'll look at the totality of the data. Growth is one thing. So is inflation, so is labor market data. So we'd look at the total, as we make decisions about policy changes going forward, we're going to look at all those things, and particularly about as they affect the outlook. It's ultimately all about the outlook and the balance of risks as well. So that's what we'd be looking for. If we have stronger growth, that'll be good for people. That'll be good for the labor market. It might actually mean that it takes a little longer to get inflation down to 2%. We will get it down to 2%. But if we see stronger growth, we will set policy according to what we actually see, and so that's how I would answer.
I guess the question I'm asking, if you don't mind a quick follow-up, I guess the question I'm asking is above trend growth itself a problem?
It's only a problem it's not itself a problem. It's only a problem insofar as it makes it more difficult for us to achieve our goals. And if you have growth that's robust, what that will mean is probably will keep the labor market very strong. It probably will place some upward pressure on inflation. That could mean that it takes longer to get to 2% inflation. That could mean we need to keep rates higher for longer. It could even mean ultimately that we would need to hike again. It just is. It's the way our policy works.
Neil.
Hi, Chair Powell. Neil Irwin with Axios. How do you interpret the state of the labor market right now? And in particular, you've referred even today to evidence that it's coming into better balance. What would you need to see to conclude that it has reached that balance?
So on the better balance side, just a lot of things. It's you see job growth still strong, but moving back down to more sustainable levels given population growth and labor force participation. The things that are not quite, but let me go on with that list. Claims are low. If you look at surveys of businesses, they're sort of the era of this frantic labor shortage are behind us, and they're seeing a shortage of labor as being significantly alleviated. If you look at shortages of workers, whereas they thought job availability was the highest it had ever been or close to it, that's now down to more normal levels by so many measures: participation, unemployment, so many measures, the unemployment, job openings, quits, all of those things. So wages are still running a bit above what would be consistent with 2% inflation over a long period of time. They've been gradually cooling off, but if wages are running around 4%, that's still a bit above, I would say. And I guess there are just a couple of other. The unemployment rate is very, very low, and these are. But I would just say overall, the development of the labor market has been very positive. It's been a good time for workers to find jobs and get solid wage increases.
Claire.
Claire Jones, Financial Times. I'd say the mood among economists at the moment seems to be one of cautious optimism, which is somewhat corroborated by your forecast, by this sense that we are going to have a soft landing. When we hear from the general public, there's a lot of discord about economic conditions. What do you think explains this disconnect, and does it matter for policymakers?
It may be. A common theme is that while inflation is coming down, and that's very good news, the price level is not coming down. Prices of some goods and services are coming down, but overall, in the aggregate, the price level is not good. So people are still living with high prices, and that is something that people don't like. And what will happen with that is wages are now, real wages are now positive, so that wages are now moving up more than inflation as inflation comes down. And so that might help improve the mood of people. But we see those public opinion surveys. The thing that we can do is to do our jobs, which is to use our tools to foster price stability, which has such great benefits over such long periods of time, and which is the thing that really enables us to work for and achieve an extended period of high employment, which is so beneficial for families and companies around the country.
Victoria.
Hi, Victoria Guido with Politico. I wanted to ask, on the flip side of if things start to deteriorate rapidly, if we do fall into a recession, if we do start to see unemployment rise at sort of the levels of inflation that we're seeing now, how would you all think about that in terms of rate cuts? Would that be a sign that you've done your job demand-wise?
Sorry, if
the economy looks like it's starting to fall into recession, if the jobless rate starts to rise?
That's not something we're hoping to see. Obviously, we're hoping to see something very different, which is continuation of what we have seen, which is the labor market coming into better balance without a significant increase in unemployment, inflation coming down without a significant increase in unemployment, and growth moderating without a significant increase in unemployment. That's what we're trying very much to achieve, and not something we're looking to see.
But would you take that as a signal that you should cut rates?
Obviously, what we'll do is we'll look at the totality of the data, as I've mentioned a couple of times, and certainly the labor data would be important in that. And if you can describe a situation like that where if there were the beginning of a recession or something like that, then yes, that would certainly weigh heavily in that decision.
Michael McKee from Bloomberg Television and Radio. Mr. Chairman, you were, by your own admission, behind the curve in starting to raise rates to fight inflation. And you said earlier, again, the full effects of our tightening cycle have not yet been felt. How will you decide when to cut rates, and how will you ensure you're not behind the curve there?
So we're aware of the risk that we would hang on too long. We know that that's a risk, and we're very focused on not making that mistake. And we do regard the two, we've come back into a better balance between the risk of overdoing it and the risk of underdoing it. Not only that, we were able to focus hard on the price stability mandate, and we're getting back to the point where, which is what you do when you're very far from one of the two mandates. You're getting now back to the point where both mandates are important, and they're more in balance too. So I think we'll be very much keeping that in mind as we make policy going forward. And the things we'll be looking at, I've already described. You know, we're obviously looking hard at what's happening with demand. And what we see the same thing other people see, which is a strong economy, which really put up quite a performance in 2023. We see good evidence and good reason to believe that growth will come in lower next year. And you see what the forecasts are. I think the median participant wrote down 1.4% growth, but you know, we'll have to see. It's very hard to predict. We'll also be looking to see progress on inflation and you know, the labor market remaining strong, but ideally without seeing the kind of large increase in unemployment that happens sometimes.
When you begin the cutting cycle, will it be essentially run the same way you do it now with raising rates, where you basically do trial and error, cut and see what happens, or will you tie it to some particular measure of progress?
We haven't typically tried to articulate, with one exception, really specific target levels, which was, some of you will remember the thresholds that we used in, I guess, 2013. The answer is these are things that we haven't, you know, really worked out yet. We're sort of just at the beginning of that discussion.
Edward. Thank you, Mr. Chairman. Edward Lawrence of Fox Business. So if the Fed cuts rates, as the dot plot is showing, about 75 basis points, does that signal or that there's a belief of weakness next year in the economy?
It wouldn't, if that were, first of all, let me just say, that isn't a plan. That's just accumulating what people wrote down. So that's not something, you know this, but allow me to say it again. We don't debate or discuss what the right, you know, whose SEP is right. We just say what they are and we tabulate them and publish them. So it's, you know, it's important for people to know that. But it wouldn't need to be a sign of, it could just be a sign that the economy is normalizing and it doesn't need the tight policy. It depends on, the economy can evolve in many different ways, right? So, but it could be more what I just described.
And you focused on core inflation. We've heard from in other meetings. How sticky is core inflation right now?
Well, that's what we're finding out. And we've seen real progress in core inflation. It has been sticky, and famously the service sector is thought to be stickier, but we've actually seen reasonable progress in non-housing services, which was the area where you would expect to see less progress. We are seeing some progress there, though. In fact, all three of the categories of core are now contributing. Goods, housing services, non-housing services, they're all contributing at different levels, you know, meeting by meeting, or rather report by report. So, yeah.
Okay, let's go to Katerina.
Katerina Saraiva, Bloomberg News. Thanks for taking our questions. I just wanted to ask a little bit about, you know, we had some pretty positive data this morning and yesterday. I'm assuming those were not incorporated into the forecasts we see today. But I just wanted to ask, you know, how that kind of adds to your thinking, you know, on the inflation outlook.
Right. So we got CPI the morning of the first day, and we got PPI the next day, which informs the translation into PCE. So it's very, very late in the game, you know. But nonetheless, participants are allowed to, encouraged to update their SEP forecasts until probably mid-morning today. After that, so staff has to accumulate all of that and create the documents that you see. So until about mid-morning, maybe late morning, it's okay to update. And I believe some people did update their forecasts based on what we saw today.
Okay, and you see, I mean, how are you, when you think about, you know, starting to think about the rate cuts next year or whenever they come, how do you think about the economy we're in now, kind of post-pandemic? Do you think that there's been significant structural shifts, and is that going to change how you look at a rate cut path?
The question of whether there have been fundamental structural shifts is really hard to know the answer, and a very interesting one right now. The one that would affect, one that comes to mind, though, is just the question of where the neutral rate of interest is. And so, for example, if it's risen, and I'm not saying that it has, but if it were to have risen, that would mean that interest rates would need to be a little bit higher to convey the same level of restriction. The thing is, we're not really going to know that. People will be writing papers about that 10 years from now and still fighting about it. So it's just that it's going to be uncertain. So we're going to be making policy in this difficult, uncertain, really unprecedented environment. Someone once said that you know the natural rate of interest by its works, and that's really right. But that's very difficult because policy operates with a lag. So it's one of the reasons why we slowed down this year. We started slowing down at this meeting last year, reducing the pace at which we were adding restriction. And over the course of this year, we really slowed down a lot to give those lags time to work. In terms of demand, has demand shifted more away from services into goods? You can make a case for that the shift back into services has not been complete, and it doesn't look like it's ongoing, but I don't know if that's right. Maybe people just bought so much stuff that they temporarily don't want any more stuff. They haven't got any place to put it.
Let's go to Jennifer.
Thank you, Chair Powell. Jennifer Schonberger with Yahoo Finance. You said back in July that you needed to start cutting rates before getting to 2% inflation. As you mentioned, PCE inflation is now running at 3.5% on core. On a 6-month annual basis, core PCE is running at 2.5%. Though when you look at super core and shelter, they are, of course, stickier. So in looking at the different components of the data, how much closer do you have to get to 2% before you consider cutting rates?
I mean, the reason you wouldn't wait to get to 2% to cut rates is that policy would be too late. I mean, you'd want to be reducing restriction on the economy well before 2%, because before you get to 2%, so you don't overshoot. If we think of restrictive policy as weighing on economic activity, it takes a while for policy to get into the economy, affect economic activity, and affect inflation. So I can't give you a precise answer, but if you look at what's in the SEP, and I think you'll see a reasonable estimate of the time lags and things like that it would take.
Do you think below 3% would be reasonable?
I wouldn't want to identify any one precise point, because I would be able to look back then and probably find out that it turned out not to be right. But we'll be looking at it and looking at the broad collection of factors.
Hi, Chair Powell, Jean Young with Market News. Wanted to go back to the stickiness of inflation question. Over the past couple of years, a lot of central bankers have talked about the more difficult last mile of getting inflation back down to 2%. Yet it's also been surprising how fast inflation has come down this year. I'm curious, do you think something has changed in our understanding of inflation? Or do you subscribe to this notion still, or is it something different about the U.S. economy? Thank you.
I think this. We felt since the beginning that it would be a combination of two factors. The first factor is just the unwinding of what happened in the pandemic, the distortions of supply and demand, and the second thing would be our policy, which was weighing on aggregate demand and actually making it easier for the supply side to recover because of lower demand. We thought those two things were going to be necessary. Sorry, say the last part of your question again.
If there was something different about the U.S. economy.
Yeah, so it's not that it may or may not be about the U.S. economy being different. I think that this inflation was not the classic demand overload, pot boiling over kind of inflation that we think about. It was a combination of very strong demand, without question, and unusual supply side restrictions, both on the goods side but also on the labor side, because we had a participation shock. So this is just very unusual. And we had the view, my colleagues and I broadly had the view, that we could get a lot of, you had essentially a vertical supply curve, because you ran into the limits of capacity at very low levels because there weren't workers and because people couldn't, the supply chains were all broken. So we had the view that you could come straight down that vertical supply curve to the extent demand reduced, and something like that has happened. It happened so far. The question is, once that part of it runs out, and we think it has a ways to run. We definitely think that the sort of supply chain and shortages side has some ways to run. Does labor force participation have much more to run? It might. Immigration could help, but it may be that at some point you will run out of supply side help, and then it goes down to demand, and it gets harder. That's very possible. But to say with certainty that the last mile is going to be different, I'd be reluctant to suggest that we have any certainty around that. We just don't know. I mean, inflation keeps coming down. The labor market keeps getting back into balance, and it's so far so good. Although we kind of assume that it will get harder from here, but so far it hasn't.
Okay, we'll go to Megan for the last question.
Hi, Chair Powell. Thanks for taking our questions. Megan Casella with Barron's. I want to ask about the balance sheet, given the Fed's focus now on proceeding carefully and considering rate cuts. And can you talk us through what the latest thinking is, and has there been any consideration of altering the pace of quantitative tightening at all?
We're not talking about altering the pace of QT right now, just to get that out of the way. So balance sheet seems to be working pretty much as expected. What we've been seeing is, that we're allowing runoff each month. That's adding up. I think we're close to 1.2 trillion now. That's showing up. The reverse repo facility has been coming down quickly, and reserves have been either moving up or, as a result, or holding steady. At a certain point, there won't be any more to come out of, or there'll be a level where the reverse repo facility levels out, and at that point, reserves will start to come down. We still have, that we intend to reduce our securities holders until we judge that the quantity of reserve balances has reached a level somewhat above that consistent with ample reserves. And we also intend to slow and then stop the decline in size of the balance sheet when reserve balances are somewhat above the level judged to be consistent with ample reserves. We're not at those levels. With reserves close to $3.5 trillion. We don't think we're at those reserves. There isn't a lot of evidence of that. We're watching it carefully, and so far it's working pretty much as expected, we think.
Adjusting that thinking at all by the time you're considering or moving forward with rate cuts? Is that time to rethink, or are you still going to follow that thinking?
So I think they're on independent tracks. So you're asking, though, the question, I guess you're implying the question of can you continue with QT at such time, QT, which is a tightening action, at such time as policy is still tight? And the answer is it depends on the reason. If you're cutting rates because you're going back to normal, that's one thing. If you're cutting them because the economy is really weak, so you can imagine you have to know what the reason is to know whether it would be appropriate to do those two things at the same time. Thanks very much.
Chairman Powell wrapping up 2023 and unleashing a monster rally. From New York City this afternoon, good afternoon, good afternoon. Alongside Tom Keene and Lisa Brabitz, I'm Jonathan Ferro. Here are the scores in the equity market right now. On the S&P 500, up by more than 1%. On the NASDAQ, up by 1.1%. The words of Emily Rowland of John Hancock Investment, it's a pivot party and everybody's invited. Chairman Powell just turned up the music. In the bond market, 2-year, 10-year, 30-year, look a little something like this. We're down 26 basis points on a 2-year to 4.47. On a 10-year, we're down 16 to 4.04%. We all had a big question coming into this news conference. Would Chairman Powell push back against these big moves in this bond market, these big moves in this stock market? He said we still have a ways to go. Nobody is declaring victory. That would be premature. Then just seconds later, he said this.
And a question of when will it become appropriate to begin dialing back the amount of policy restraint in place. That begins to come into view. And is clearly a topic of discussion out in the world, and also a discussion for us at our meeting today.
We discussed the timing of rate cuts at today's meeting. Lisa Bramwitz, that was not the pushback some people were looking for.
If this was pushback, he might as well have screamed, "We did it," and popped champagne, right? If you're talking about a party, he basically endorsed the view that we have of the market. What I'm looking at right now is the expectation of 140 basis points of rate cuts being priced into Fed funds futures for next year. This is basically an endorsement of that by Fed Chair Powell, who had ample opportunities to push back and did not.
To me, it's beyond that. It's to the real economy. This is truly an historic meeting. I did not expect that. I went back to March of 2020. Let's call it the pandemic meeting, certainly with that impact. But I think you've got to go back 25 years. What was unspoken there is everybody plays the Fed parlor game and this and that and the other, is this is a resounding vote in the American real economy and in the productivity of the country. That's going to all be in the research over the next 48 hours.
It's seduced by engineering that soft landing.
To me, it's immaculate productivity.
Really
That's my
leaning
new
into
phrase.
that. Really leaning into that in a big way.
Yeah, I can't, I got goosebumps right now, folks. I can't emphasize how unique this meeting is. I have no idea how Lagarde and Dudley respond to this. I have no idea what Christine Lagarde does tomorrow.
I like your phrasing, seduced by the idea that they could potentially get a soft landing. And the response to the question about the easing of financial conditions and whether that worked against their goal was not particularly, I don't want to say satisfactory, but didn't really give me a sense of what the answer actually was, right? Because we're looking at a situation where people are just all in, endorsing bonds, endorsing stocks, endorsing the soft landing, and it is very rare. It is a unicorn. And so how much does this start to push things in the opposite direction?
John, I'm going to frame this. I wrote to Mohammed El-Arian, I think it was out on Twitter, like 20 minutes before, and I said 2 standard deviations is 4.06%. That's right where we went. I did not expect that. We blew through that and almost hit the Bramo line, which is 3.99XX. We didn't get there. We did not get to the land of Bramo, but we were really quite close.
You have to remember, Tom, at the end of October, when people put together their year-ahead outlooks for the end of 2024, targets like 5,200 was 20% upside from where we were. And now you wonder, TK, is it bullish enough? And that's going to make people really, really uncomfortable as we start to bring forward a ton of gains into year end.
I'll be quick here. We got some two special guests for you right now on radio and television. But John, what I saw there is what I'm going to call non-log convexity, which is a curve to the Russell 2000, which is an acceleration of money in. And I just wonder to year end how traditional money reacts. And if you get what Greg Peters talked about, which is some legit convexity here.
What's the bet? I think the bet right now, Tom, is that growth doesn't get hit hard. This Fed's going to cut based on what we've just been told by Chairman Powell, or rather what we weren't told, and what's implied already in market pricing. But Lisa, what would upset the bet? What would upset the bet right now is you get a real downturn in the economy. That's not part of this story that's been priced in at the moment.
And there's dissonance when the Fed statement is saying that there is a lagging effect, a lagging impact of Fed rate hikes that hasn't yet been played out. If that's the case, where is that in the statement of economic projections?
We have a terrific lineup for you, and we start strong here after this historic press conference with William Dudley. He's a former New York Fed president, a student at California, Berkeley years ago of our monetary history, and of course, Bloomberg Economics senior advisor. As I said, Bill, I got goosebumps. It just seems to be a massive statement that even if we have nominal GDP of 4%, we have immaculate productivity and will somehow get through this. Do we sustain this market reaction, this belief in America, or are we set for some titanic disappointment?
Well, I think that Powell's press conference made clear that he's really pleased by how the economy's performed. The fact that you could get inflation down without the unemployment rate going up, if you had some moderation in wages, he thinks everything is going really, really well. And I think that's true. The question is whether it's going to continue or not. And there are definitely things that can go wrong. One thing that can go wrong is the Fed keeps monetary policy too tight for too long and we have a weaker economy. Another thing that can go wrong is the Fed can ease policy prematurely, or the market itself can ease financial conditions prematurely, which will stimulate the economy and make it so that the Fed can't cut rates as quickly as the market expects. I think the market's getting a little ahead of itself here in the sense of taking the Fed's optimism and translating that into very large reductions in short-term rates in 2024.
Bill, what do you think happened to the Chairman Powell of only 2 weeks ago?
I just think that they're very happy with how the economy's performed. I mean, basically, they've had decent growth, unemployment rate's stable, and inflation's come down a lot. And that's basically, as good as it can get. And that's really what's summarized in the summary of economic projections. Now, summary of economic projections shows a very modest increase in the unemployment rate from here and essentially a soft landing kind of forecast. Now, soft landings are really difficult to pull off, and they're particularly difficult to pull off when you've been very late to tighten monetary policy. And what's allowed this to happen is that there were supply disruptions, there was reduction in labor supply. Both those things have reversed, and that's made the Fed's job a lot easier.
Bill, the prospect of getting sticky inflation into next year, getting stuck at 3. It's amazing because 6 months ago, Bill, we were told that the last mile was difficult. It was hard. Then Secretary Yellen starts sounding like the Fed chair again, saying it's not that hard. You hear it from Chairman Powell, didn't get any indication it would be particularly difficult into next year. Do you think that is the prudent approach to what 2024 could look like?
I think he's telling you what he really thinks. I think he's very happy with how things have performed. And he didn't say it would necessarily continue, but he also said that he was hopeful that these trends would continue into 2024. My own view is that the Fed is going to be cutting rates in 2024. We're clearly done in terms of rate hikes. The possibility of another rate hike is really low at this point. The question is really just timing of rate cuts and magnitude, and that's going to basically be driven by the strength of the economy, pressure on resources, and what actually happens to services inflation at this point.
Bill, do you think that Jay Powell did a good job? Do you think that it was right for him to say what he thinks and not push back at all against the market party?
I always think it's good to say what you really think, but I think the problem with doing so is it's basically added fuel to the fire. Powell talks about the long legs of monetary policy, but financial conditions are much, much more accommodative than they were just a few months ago. And if you look at the Fed's own assessment of financial conditions back at the end of October, the impulse from financial conditions to the economy based on the Fed's own model was pretty neutral. So financial conditions now are actually adding impulse towards economic growth going forward.
I look, Bill, at where we are, and it's clearly beyond the pandemic. We've had a number of conversations all across a long surveillance day about how goods are goods, and we've got some deflation and service sector inflation's coming down. Is this economy beyond the pandemic? If you were to talk to Mary Daly in San Francisco, to John Williams at the New York Fed, can we say our economy is beyond the pandemic?
I think mostly in the sense that the conditions today are very similar to where we were in February 2020 when we had a very tight labor market. The difference is wages are a bit higher, inflation's a bit higher, and monetary policy is considerably tighter. But it does feel more like February 2020 than it does between any period after that.
Bill, sit tight. I want to bring in Mike McKee down in Washington, D.C. Michael McKee, you were in that news conference. Were you surprised by the approach from Chairman Powell?
Well, I wasn't surprised by the approach once we'd heard from the Fed and in their statement and what we saw in the dot plot. But it is a rather dramatic change from what he said just 12 days ago about it not being time to talk about rate cuts. Obviously, they did today. They're feeling much better about the overall state of the economy. As one analyst put it today, if a good inflation report is Jay Powell's idea of a good time, then his party has turned into a rager because inflation is coming down very quickly. And then the next question becomes, as I asked him, when do you cut? And that's the part they're not ready to get into yet or describe. And so we're probably still in for a few months of the markets watching the data and trying to guess when the Fed is going to respond.
Michael, within all the blur of the data and all the guesstimates forward, did they frame out a subpar GDP, either real or nominal? Did they frame out subpar growth?
Well, basically, that's what Powell said we're going to get because the direction of the economy is slower and the lagged effects of their rate increases have not yet completely been felt. But that the economy will start picking up again and growing to potential. And he also admitted the possibility of a surprise there, that the economy grows faster than expected, is also very real. So I think they're, at this point, working on the models that they have, but admitting that they have been wrong before and we could see faster growth. But the interesting thing was, other than a sort of perfunctory caution, he wasn't suggesting that we are now, that they would go back necessarily to rate increases.
Mike McKee, thank you, sir. Great job today, as always. The reaction pouring in this afternoon, this line from Steve Cheverone over at Federated. Initial take is he wants to cut. He always saw inflation as transitory. Bramo, your favourite. It's come down on the supply side. He smells a soft landing and wants to cut to stick the landing. He had no interest in pushing back against market expectations. Right or wrong, it's bullish for now. That's a takeaway from Cheverone this afternoon.
That's exactly where I wanted to go, and I wanted to get Bill Dudley's opinion about whether we did get basically confirmation of transitory. Do you think when we look back, the Fed won't have been wrong when it came to transitory inflation? They just were premature.
I think that most of the inflation pressure we had was transitory, but not all of it. I mean, I think some of the services inflation is due to the tightness of the labor market. I think what's really interesting about Powell's press conference today is he talked also about the risk of being too late to cut. So he actually admitted the possibility that if we stay tight for too long, we could actually have an economy that's too weak relative to what we desire. And that's something new from Chair Powell.
That's a very important point, the ex-postedness of it, if you will, Dr. Dudley. They've got to wait after the fact. So let's take something coarse like the unemployment rate. How many months do they have to wait until they get real confidence that the labor economy is caught up with our immaculate disinflation?
I think they're going to be looking at what happens to the unemployment rate, the tightness of the labor market, and what the consequences of that are for wages. Powell did admit that wage inflation is still a little bit too high to be consistent with 2% inflation. But boy, the Fed is pretty close to where they want to be in their outlook at this point.
Bill, you've been on the committee before. You can look at this from the outside now. It's a tricky game, this one, to get into someone's head, and I think maybe one we shouldn't play, but I think on this occasion we should. 2 weeks ago, I heard from a very different Fed chairman, and I'm trying to work out what happened today, whether that was just a man who was representing his own views and this was a man who was representing the committee's view, or whether, like we've indicated, he's being seduced by this idea of netting a soft landing, and the guy who was trying to act like Volcker was never really Volcker. What is it? What do you make of who Chairman Powell is and what he ultimately thinks about things?
Well, the fact that he's worried about keeping monetary policy too tight for too long tells you that he's not thinking like Paul Volcker. So there is there is a risk to the Fed cutting rates prematurely. But I think what's coming across is the fact that he's just really, really happy with how things have evolved, and that optimism is showing through, as it has shown through from time to time in past press conferences.
Right. Bill, it's maybe not your remit, but it's certainly the New York Fed's remit. They're going to keep track of flows off of declining interest rates. What is the stability or instability that you observe in $6 trillion of cash, let's say most of it loaded in money market funds? As that yield comes down, is our system going to be able to handle it?
Yeah, I don't think there's going to be any problem. I mean, the Federal Reserve sets the short-term interest rates, and then money market rates trade off that. If money market rates, firm up a little bit, then money will flow back into the money market mutual funds. I'm not worried about that at all at this point.
Bill, just to wrap it all together, do you think that the chance of a hard landing has gone down materially over the past month, or do you think that it's about the same or even has gone up?
I think it's gone down materially over the last 6 months. I mean, over the last month, I don't think things have changed very much. But definitely the prospects of a soft landing are the best they've been in the last year or two.
Something changed in the last 2 weeks for Chairman Powell. That's for sure. Bill, good to catch up. Bill Dudley there of Bloomberg Opinion, former New York Fed president. Let's recap the price action. Some wow moves across the board in the equity market and in bonds since the start of November, the end of October. This afternoon at 1%. 0.5% on the S&P. The gains fade a touch, but big gains nonetheless. On the Nasdaq, up by 0.9%. How about the Russell? The small caps up by 2.7%. We're talking about gains of more than 10% since early November on the S&P 500. A year in a month. In the bond market, 2-year, 10-year, 30-year, 2-year, 4.47. When the Fed met in November, the morning of that meeting, on the second day of that meeting, 4.92 on a 2-year. Right now, 4.47.25. What a turnaround, TK. Close to 5% and all the way back down again.
Yeah, there's anything we're always looking at. I mean, it's something as idiosyncratic as a Turkish lira is on a bid today for the first time since the time began. But yeah, you can look across all of the equities, bonds, currencies, commodities and see the effect of this. John, I want to go on 1 week. I want to go on 2 weeks. Every strategist out there has to republish and readjust. And let me tell you, you got your outlook to bed December 5.
Yeah.
Let's go in this weekend. We're rewriting it. I mean, this is that dramatic.
I have to correct what I said. I was quoting the 10-year. The 10-year was a 4.92. The 2-year, back in early November, was 3.5%. These are massive changes. Back down to 4.47 on a 2-year. On a 10-year, just above 4%. Brammo, in the FX market, I think we've got to talk about this. The tug of war that we're going to see play out now, off the back of what we've just heard and into tomorrow with the ECB. The euro at the moment looks like this, 108.68. That currency pair positive by 0.7%. Given the moves we've seen in the bond market, that dollar is a whole lot weaker. Where does this leave President Lagarde in tomorrow's meeting?
Hold my beer. I mean,
right?
Essentially, is this what she's going to say is, okay, I'll take that and I'll raise you by saying, I think we should cut rates in March. This is going to be a bigger question. Did the whole world experience pandemic-era inflation that has largely subsided and that was ultimately transitory, or is there something else at play? Jay Powell did not want to embrace the question about financial conditions loosening and what that means. Are we going to hear the same thing from Christine Lagarde?
There was a moment in that news conference, just a moment, where he reflected on how wrong so many people have been in 2023. And I think before we go home for Christmas, the holidays, and look ahead to 2024, Tom, we need to reflect with some humility about what went wrong in 2023. Last year, 12 months ago, looking out 12 months, we were talking about the prospect of recession, of much higher unemployment. We called the Fed's forecast aspirational. TK, we had bank failures, some of the biggest bank failures we've seen in decades, not just in this country, but around the world. And yet, a couple of quarters later, we had GDP north of 5%.
That's the key point.
So when we talk about netting a soft landing, getting all these rate cuts the Fed is talking about without the economic weakness, I think we've got to remember this has been a very, very, very difficult economy to forecast, and the next 12 months might be equally as tricky.
We're repiecing the show together for tomorrow, folks. This is so profound. Our team's going to work all evening to give you the best tomorrow morning that we can. And Amy said to me, who do we talk to? And, you know, the usual names. You mentioned Bob Michael, J.P. Morgan. I think to see a bank like J.P. Morgan recast their view forward. But I looked to Urian Timmer at Fidelity with decades of experience of real economy analysis. And this is the Lagarde distinction. If we do 4% nominal, what's the character of that American 4% growth versus whatever number you have in Europe? They don't have the technological pop that we have.
Can we introduce some politics into this?
Did you speak with Vice Chair Biden?
This gets really, really difficult. Going into next year, okay, let's say we get 75 basis points of cuts. Where are they landing? And does the political calendar shape where you think that comes, Lisa? Given that we're going to have campaign in full flow going through next year, are you telling me they're going to wait until June? We had Matt Lazzetti at Deutsche Bank on the program a little bit earlier, Lisa, and he said they start in June and they go 175 basis points. They start in June and go 175 into the election.
Right now, there is a 74% chance of a rate cut at the March meeting for the Federal Reserve. That is what I'm looking at in terms of what people are expecting. If the Fed is currently talking about cutting rates, why would they wait until June? For politics, they could be accused of political interference either way, deciding on when they move.
TK, that's the question. Why wait?
Well, there's the why wait, but there's also look at the further data. And again, I'm skewed towards a study of the real economy. We finished strong here. Jeffrey Rosenberg with his portfolio manager, BlackRock Systematic Multi-Strategy Fund. He will be systematically reviewing everything after this historic meeting. Jeff, you know, we're at gunpoint at Carnegie Mellon. You were required to read both volumes of Alan Meltzer. and get out the 60s, the 70s in Fed meeting. And what Dr. Meltzer would say is it is, at the end of the day, about the real economy. What did Jerome Powell today say about the American economy with this stunning statement, the dots in the Q&A?
Yeah, it was overall a validation of the transitory view. And, you know, what was a little bit feared going into the press conference was whether he would push back. He got the softball from Nick Timiraos on financial conditions.
Now be nice.
And clearly, you know, chose not to hit it out of the park in terms of pushing back on financial conditions. And that was a green light to continue the initial reaction from what we got in the statement of economic projections and the dots, and the 75 basis points in the dots is clearly the surprise. So, you know, this is a green light for investors. I think Nick's question and this question of financial conditions, and Bill Dudley mentioned it a minute ago, this is the problem, is that this can go on for a while and it can get overdone in terms of how much easing the market does before the Fed. But the message today is the Fed is very happy with what they've seen. What changed? You know, clearly it's the validation on the inflation story. And they're very pleased that after getting it wrong for so long, they're really getting the validation in getting it right.
So, Jeff, what do you do? Stay on the ball, hold on, grip tightly, don't let go? What do you do?
I mean, the short term is you can't really fight this until there's some kind of fundamental data from the economy side that pushes back. And there hasn't been. It's all been coming up. Soft landing, inflation declines. Yesterday, you can squint at core. Nobody seems to look at core anymore. He mentioned it very briefly. It actually popped up. So there are some, you know, vulnerabilities, but the message and the concern, no one's looking at the vulnerabilities. They're looking at the validation. And so with that validation, this bullish sentiment can go on for a while until we get a new round of economic data. And until then, I think the message is pretty clear that the Fed is more than willing to see an easing in financial conditions, won't step in the way of that.
Kathy Jones of Charles Schwab, put this out on X or Twitter. With that, I have to revise my 2024 outlook. Happy to do it. Are you revising your 2024 outlook after this meeting?
You know, I've done this for so long that I don't do the whole, you know, Christmas in July, outlooks in October kind of thing, because you end up with this problem. So, no, I don't have to revise it because I just haven't put it out yet. So that's a good plan.
It's a bold strategy. You know, I looked, Jeff, at where we are, and I just looked up one of the BlackRock money market funds, 5.2491%. Where's all that money going? I mean, this is right up your wheelhouse. Where's all that money going when that yield comes down?
You know, you asked this question in the pre-segment to one of the guests, and I was listening in, and, you know, this is the change. This is the turning point.
I agree.
Last year, it was all about you're rewarded for staying in cash when the cash rates are going up. When the cash rates start going down, now your rate of return starts going down in cash. So it is the signal to start moving out of cash into more term rates in fixed income, to lock in rates at their highest yields if you're going into a cutting cycle, to move back into risk as we talked about earlier, the lack of a hard landing, the over forecasting of recession fears, the legacy of the damage of 2022 that's kept people happily in cash, all of that dissipates. And I think that's what I was referring to before. You got to be careful as to how big that easing in financial conditions can become and how that can undo some of what the Fed thinks is the right stance. But that being said, this is a turning point, and I think you do start to see that money move out of money markets into riskier assets, into more term rates, to lock in higher rates. As the cash rates start to come down, you're penalized now in 2024 for holding cash because the rates and the prospect of the rates is to go lower.
Jeff, what would you advocate for? You're sitting in cash, you've missed the rally of the last month, you see yields drop and you get nervous. Reinvestment risk is not just something to worry about, it's real. You see the moves in a single day of more than 20 basis points. What are you advocating for?
Well, I think there's lots of different ways to step out of cash into. It depends on the risk perspective, but in fixed income, that movement into the front end of the curve, you can step out a little bit more into the belly. It's going to lock in not only some yield levels, but you'll pick up a bit more price appreciation in a total return context in a falling rate environment. I think you can go further. The soft landing, the lack of economic recession, it bolsters yield and yield pickup in terms of income and credit risk. That credit risk, it's priced in, but it's not going to collapse. And so if you avoid the recession, investors can step out on the risk spectrum in fixed income, increase yield levels relative to cash, lock those in. And as long as that recession outlook is avoided, and that's not a guarantee, but that seems, again, with what the data is showing to be the more likely scenario, you'll lock in those yields and achieve a higher return than what you're going to get out of sitting in cash.
I want to just point out that we're down now about a percentage point in less than a month on 10-year benchmark yields. This is full faith in credit, the most liquid market in the world, and we're seeing fluctuations that we have never seen before. Does that raise any concerns for you that we are seeing such incredible volatility in just the market's psychology on not that much different in terms of news, as you pointed out earlier?
Yeah, it's a really good point. When thinking about what the fixed income market looks like from a portfolio context, we just have to get more used to this higher level of volatility. The ag index, the benchmark for fixed income, used to be a 3 to 4% volatility instrument. Today, it's about double that. So when you're balancing out portfolios, there's just a higher level of risk. You can mitigate that by being shorter in terms of duration. Some of the more attractiveness in the front end of the curve is you've got still the highest yields, and with the lower duration, less volatility, but a bit less price appreciation too. So there's a little bit of a trade-off there. But it is, to Lisa's point, you got to expect this isn't the old fixed income market. It's a newer fixed income market. It means higher volatility, better yields still in the front end until we normalize.
Hey, Jeff, one final question. Torsten Slok at Apollo had out a stunning chart today of the spike in bankruptcies. Within all this, and I mean from a political economic standpoint, the history of this meeting, the shock of this meeting, is this a meeting that just benefits the haves of America? Half this country's flat on their back, and the others are living large. The Dow's up 460 points. Is this just about almost the financialization and advantage of the elite in America?
So I love Torsten, love his work. What he's highlighting now, and he's done this for a while, is there's a distributional aspect of our economy that gets lost in these aggregate statistics. And so there is an impact of rising interest rates. There is an impact of the significant tightening in interest rate policy. But you don't see it as much in the aggregate. You see it when you disaggregate and that distributional side. So the bottom end of consumers, the bottom end of credit is more vulnerable, and you're starting to see that. But it's still a distributional story. It's what you would expect to see in the tails, and it is showing the effect of that. But that doesn't necessarily mean that story is exacerbated, extrapolated into the aggregate view. It's part of the story. It's an important part. Credit cycles begin from the bottom, and so you got to watch that. But the counterpoint is that the rest of the distribution has created a lot of immunity, if you will, not permanent immunity, but a lot of reservoirs to buffer the increases in interest rates. On the consumer side, that's from savings. On the corporate side, that's from fixing maturities and terming out interest rates. And the reason is we had such a prolonged period of zero interest rates, so that the shock of interest rates isn't as much of a shock as it appears. It can be, and we have to watch it. And you're certainly seeing it, as Torsten's highlighting, in some of the tails, but it's not really the aggregate story yet.
Jeff, I've got a few seconds. Pick a month for the first rate cut. I know you're not going to give us an outlook, but just pick a month, Jeff.
I'm going to give you June.
June.
Sometime in the summer.
Okay.
I think the March, and I know Neil, maybe a little bit early. What's the rush? They still want to make sure they've nailed the inflation story.
Got to leave it there, Jeff. Good to catch up, buddy. Always is. Jeff Rosenberg there of BlackRock. The Federal Reserve Chair does not want to declare victory. Let me tell you, this market already has. In the equity market right now, on the S&P 500 approaching a close, we look at a little something like this, up 1.2% on the S&P, the Nasdaq up 1%, the Russell up 3.5%, and Lisa, in the bond market, a monster rally.
So maybe the Fed Chair Jay Powell didn't want to declare victory, but President Biden does, and we'll hear lots about it, and he's putting out on Twitter about prices coming down. This is going to get political very quickly.
I agree with
People try
that.
to message around an economy where the story has not been told yet.
Yeah, we're going to just have a killer show tomorrow. I've been taken by surprise with this. I knew it'd be like, okay, but this is stunning.
Absolutely amazing. Coming up on the close, look out for this, more reaction to the Fed with Stanford's Professor of Economics, John Taylor, former Fed Governor Betsy Chu. From New York City this afternoon, that does it for us. Thank you for our audience worldwide. I reflect on the words of Emily Rowland of John Hancock Investment. It's a pivot party, and everyone's invited, and what a party it is right now. From New York City, this is Bloomberg.